Thanks very much for being here, and I'm pleased to be joined by Congressman Brad Sherman. Here is the reality of the American economy today. Despite a huge increase in technology and productivity, millions of American workers are working longer hours for low wages, and median family income is almost $5,000 less than it was in 1999. While the middle class continues its 40-year decline, we have 45 million people living in poverty and the highest rate of childhood poverty of any major country on earth. Half of the American people have less than $10,000 in savings and have no idea as to how they will retire with dignity. The real unemployment rate today is not 5.5%, but it is close to 11%. But here is another reality in terms of the American economy. Today, 99% of all new income is going to the top 1%. The top 1/10 of 1% now owns almost as much wealth as the bottom 90%. During the last 2 years, the 14 wealthiest Americans saw their wealth increase by $157 billion, which is more wealth than is owned by the bottom 130 million Americans. In 2 years, wealth increased for 14 people by more wealth than is owned entirely by the bottom 130 million Americans. And in the midst of all of this grotesque level of income and wealth inequality sits Wall Street. As we all know, the greed, recklessness, and illegal behavior on Wall Street drove this country into the worst recession since the Great Depression. Millions of Americans lost their jobs, lost their homes, lost their life savings, lost their ability to send their kids to college. The middle class is still suffering from the horrendous damage huge financial institutions and insurance companies did to them in 2008. I voted for the Dodd-Frank legislation, but let us not kid ourselves. Dodd-Frank was a modest piece of legislation. Dodd-Frank did not end much of the casino-style gambling that takes place on Wall Street. In fact, much of this reckless activity is still going on today. It seems like almost every day we read about one giant financial institution after another being fined or reaching settlements for their reckless, unfair, and deceptive activities. Can't pick up a paper without reading about one scandal after another. In fact, since 2009, huge financial institutions have paid $176 billion in fines and settlement payments for fraudulent and unscrupulous activities. Bank of America has paid over $57 billion. J.P. Morgan has paid over $31 billion, and Citigroup has paid over $12 billion in fines and settlements. Bank of America has been fined for foreclosure abuses, selling toxic mortgage-backed securities, LIBOR manipulation, and currency rigging, among other things. It should make every American extremely nervous that in this weak regulatory environment, the financial supervisors in our country and around the world are still able to uncover an enormous amount of fraud on Wall Street and other financial institutions to this very day. I fear very much that the financial system is even more fragile than many people may perceive. This huge issue simply cannot be swept under the rug. It has got to be addressed. During the financial crisis of 2008, the American people were told that they needed to bail out huge financial institutions because they were too big to fail. Yet today, three out of the four largest financial institutions in this country, J.P. Morgan Chase, Bank of America, and Wells Fargo, are 80% larger than they were on September 30th, 2007, a year before the taxpayers of this country bailed them out. So we bailed out the largest financial institutions in this country because they were too big to fail. And today, 3 out of the 4 largest are now much, much larger than they were when we bailed them out. Incredibly, during that time, J.P. Morgan Chase has increased its assets by more than $1 trillion, Bank of America by more than $500 billion, and after Wells Fargo acquired Wachovia, it has more than tripled its size. In other words, if any of these financial institutions were to fail again, the taxpayers of this country would be on the hook for another bailout, perhaps even larger than the last one. We must not allow that to happen. No single financial institution should be so large that its failure would cause catastrophic risk to millions of Americans or to our nation's economic well-being. No single financial institution should have holdings so extensive that its failure would send the world economy into crisis. If an institution is too big to fail, it is too big to exist, and that is the bottom line. And let's be clear, the reason we are here today is not just because of the danger these institutions pose to taxpayers. That unto itself is an enormous issue. But there is another issue as well. The enormous concentration of ownership within the financial sector is hurting the middle class and damaging the economy by limiting choices and raising prices for consumers and small businesses. Today, just 6 large financial institutions have assets of nearly $10 trillion, and that is equivalent to nearly 60% of the GDP of our nation. These huge banks handle more than 2/3 of all credit card purchases, write over 35% of the mortgages, and control nearly half of all bank deposits in this country. That simply is too much concentration of ownership and too much power. If the American people are wondering why tens of millions of Americans are being charged interest rates of more than 20% on their credit cards, more than 20% on their credit cards, while big banks can receive virtually 0 interest loans from the Fed, the lack of competition in the banking industry is a major reason for that. If Teddy Roosevelt were alive today, I think I know what he would say. And what he would say is, these financial institutions are simply too big. We have got to break them up, and he would be right. The bill that I am introducing today with Congressman Brad Sherman would require regulators at the Financial Stability Oversight Council to establish a too big to fail list of financial institutions and other huge entities whose failure would pose a catastrophic risk on the United States economy without a taxpayer bailout. This list must include, but is not limited to, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Wells Fargo, and Morgan Stanley. All of these financial institutions have already been deemed systemically important banks by the Financial Stability Board, the G20 body that monitors and makes recommendations about the global financial system. Within a year, the Treasury Secretary would be required to break up financial institutions on this list so that they cannot cause another financial crisis. Importantly, under this bill, none of the institutions on the too big to fail list would be able to receive a taxpayer bailout from the Federal Reserve, nor could they gamble with the federally insured bank deposits of the American people while they are on that list. I am delighted that this legislation has been endorsed by the Independent Community Bankers of America, representing more than 6,000 community banks. What the independent community bankers understand is that the function of banking should be boring. Boring. The function of banking should not be about making as much profits as possible, gambling on derivatives and other esoteric financial institutions. The function of banking should be to provide affordable loans to small and medium-sized businesses in the productive economy. The function of banking should be to provide affordable loans to Americans who need to purchase homes and cars. Wall Street cannot be an island unto itself, separate from the productive economy, whose only goal is to make as much money as they can. For me, this position that I'm holding today is not new. In 1994, I cast the only no vote on the House Financial Services Committee against legislation that allowed large out-of-state banks to acquire locally owned community banks. In 1999, I helped lead the opposition against repealing Glass-Steagall that allowed commercial banks, insurance companies, and investment banks to merge. And I was one of the leading opponents of the efforts of Alan Greenspan, Robert Rubin, and Larry Summers, who all told us how wonderful it would be if we deregulated Wall Street back in the 1990s.